Stop loss order. Where to place your stops, when to get in and when to get out of trades. That's pretty much what it's all about. So let's jump right into it. All right, so as you see, we've got a nice little chart here. And I'm going to start with the overall principle. You might want to write this slogan down. This has made me so much money and saved me much money. And that is this: stops go where you're wrong. Okay, so stops go where you're wrong. What does that mean? That means and this is another little slogan, when the reason for your trade no longer exists, then your trade should no longer exist. When you take a trade, you have a reason for taking that trade. When that reason no longer exists, then you should be out of the trade, but not before. Don't allow your emotions, your mind, or your imagination think, oh gosh, I don't know, maybe I should be in, maybe I should be out. No, it should be very clear, very objective, very rule-based. I know I'm in this trade, and until things change, I stay in the trade. That improves your risk-reward ratio. So let's take a look here and do a little annotation for you. So let's say that we're looking at this, and we see that we've moved down, we've moved up, we've moved down, and we're going to buy a retrace here, and this is our trade structure. All right, so what we want to do is we say, okay, where would I be wrong? Where it'd be wrong is if I'm buying this low, if this low gets taken out, then I'm wrong. Then my trade structure is gone. The reason for my trade no longer exists, therefore my trade should no longer exist, and I should be out of the trade. So my stop goes right below that. Now, what's beautiful about this is look how it keeps my risk so small. When we talk about risk-reward ratio, it is literally the range of 1 bar. So what I do is I will enter 1 penny pip per tick. In this case, we're looking at the Forex market. So 1 pip above the high of that bar, and my protective stop goes 1 pip below the low of that bar. That's how tight I can keep my stops. And that is the risk part of the risk-reward ratio, keeping it very, very, very small. Now, let's talk about the reward, because we want big rewards. Okay, so as we move forward, let's see. So boom, we're good. All right, do we want to get out yet? No, there's no reason to get out. The reason for our trade still exists. All right, let's go to the next bar. Boom. Now, this is where a lot of people would maybe start to get a little bit worried, where their imagination, and a lot of what happens in your trading is your imagination, by the way. So base it on reality. Now, some people might say, but wait, there is a reality here. And that reality is this resistance over here. Okay, that's legitimate. But the question is, just because every resistance level, by the way, is potential resistance, I would encourage you to add that word in front of support and resistance every time. Potential resistance, potential support. And of course, support resistance levels are broken a lot. Why? Because, well, if they weren't, the market wouldn't be able to go anywhere. So the question, of course, is will it break through this time? This time meaning the time I'm in the trade. And the answer to that question is there enough demand? Supply-demand imbalance is all that makes the markets move. Is there enough buying? Is there enough buying money behind this in order for it to break that potential resistance? That is the only thing that determines whether resistance or potential resistance will be broken. Well, nothing has changed. Remember our original slogan. If the reason for your trade no longer exists, then your trade should no longer exist, but the reason for our trade does still exist. Nothing has changed. And so we're going to stay in. We are not getting out just because there's a potential resistance level there. And we need to do that so that we make more money, honey. Okay, we want to make big money. We want big reward, small risk, obviously. Now, again, we run into a similar issue. And that issue would be, well, okay, now we've got resistance over here at this level. And so now should we get out? Where again, remember, same thing, just another example. That's potential resistance. And, well, we've closed above it. Got a big green candle. Our close is above the high of this resistance level. And so nothing has really changed. Demand is still overwhelming supply. And so the money flow is still on our side, and so we're still going to stay in. And that is the answer. And then what happens? Look at that. Boom. Oh, it goes off the chart. Let me bring the chart back down here a little bit. All right. So there you go. So this is how you get big reward and little risk. Let's look back at where we started from, and you can see what I'm talking about. So our risk was that, keep it minuscule, and our reward already is that. So we don't want to just rely on support resistance for our stop loss orders, our protective stops, whatever you want to talk about them, or however you want to term them. We want to watch the money flow. It's always about the money, honey. So even if you've got news, you've got economic reports, you've got gossip, rumor, those are catalysts, but the only thing that matters is how the market reacts to them. And that will always be perfectly evident in the money flow. That's all that we care about. That's all that makes the markets go round. Money does not make the world go round. Love makes the world go round, but money makes the markets go round. So that's how this all works with support resistance. But there are other tools that we can use as well to determine if the reason for us getting in still exists. So another one of those tools would be cycles or timing. So for example, we've got a cycle high here, elongated cycle low, cycle high, cycle low. Okay, and that's actually one of the reasons that we got in, was because this is a cycle low. Cycles are about timing the markets, timing for your entries and your exits. And so now what we're going to be looking at is not just resistance, we're going to be looking at our cycles. Is this the time to exit the market? So if you want to get my timing indicator, my cycle indicator, you can get that absolutely free. I give it to all of my viewers. Just go to indicatorwebinar.com. I give you my cycle indicator. They're absolutely free, and a recorded tutorial. It's only about 40 minutes on how to trade it. We go into depth so you can actually use it, add it to your tool of indicators, and actually it's my number one indicator. It's the indicator that I rely on more than anything else for getting in and getting out. And let's face it, that's what trading is all about, is when to get in and when to get out. So you need some sort of timing indicator to know when. So go get it, indicatorwebinar.com, my gift to you.